Thanks, Mike. I just wanted to congratulate Mike for putting together a really impressive day. This is the first event that he's done here for Holt, and to put together the docket that he did is really impressive. So good job, Mike, and crew. So our panel today is a somewhat diverse. Originally, we were supposed to have David Kluwer on our panel, so he was, if you were here this morning, he's always a bit spicy in comments, but we'll try to keep it as upbeat as possible without Dave. We didn't vote him off the panel, actually. So anyway, I've known Dave a long time, so I have some latitude in commenting, I think. So before we get to introductions on the panel and some of the things that we're going to be talking about, we'll leave some time at the end for questions as well. So you can either send a question to the hashtag, or you can just ask the question at the end. So we'll make sure we leave enough time there at the end for questions. So sort of just to set the stage, obviously the rest of the country is still feeling the recession. Here in Silicon Valley, we've seen obviously a positive trend in venture investing, and certainly in early stage, there's a lot of money being invested in disruptive technologies, and we see the valuations increasing. We've seen great companies come out of downturns and recessions. If you think about the 90s, we saw Yahoo, Netscape, eBay, Amazon, Google coming out of that time. Even after the crash in 2000 and mid-decade, last decade, we saw great companies, Facebook, Twitter, YouTube, Zynga, really starting to take hold in that time. So today we're seeing new technologies, mobile platforms, gaming, location-based services, and the distribution of advertising dollars really creating a new wave of game changers. Some of those that we're all familiar with are Groupon, Scavenger, Foursquare, and certainly Zynga. Yesterday there was an announcement that Color Labs raised $41 million led by Sequoia. And they declared that every 10 years a company, a marketplace, and an opportunity come together that's transformative. They, Sequoia, told the CEO, not since Google have we seen this. Interesting though, they have not fully launched their product yet. So with this as a backdrop, today's discussion will explore a variety of topics, including how's the startup environment evolved, and how do we view the environment, how are we supporting the companies and our investments. So with that in mind, let me introduce the panel, first starting with Ann Winblatt, who is one of the founding partners of Hummer Winblatt, very well known and very established, certainly in San Francisco and worldwide. And maybe just give a little bit of background on you and Hummer and possibly your most recent investment.
Sure. We are a 22-year-old venture fund. I co-founded the firm 22 years ago with my partner John Hummer. We are investing our sixth fund. We are A-round investors, and we're a focused fund, which means we only invest in one category, which is software. Primarily, our investments are the software that actually runs everything, and we call that enterprise software, and it could be the backbone for consumer or enterprise offerings. We do A rounds, which means we're fully committed to fund your company from that round to their outcome. That means once we make an A round investment, we have to set aside funds for your B round, C round, and D round if those rounds exist. Some of our most recent investments, we just invested in a company called Strobe, which is a Sprout Core project, which is the guys out of Apple that did HTML5. We just invested in a company called Nimbus, which is a new database architecture. A company called Karmasphere, which does all the tools for developers and analysts for Hadoop and MapReduce. So that gives you a flavor of some of our recent investments. Our recent exits, Web Analytics, Omniture, we funded 18 guys, did their A round out of Salt Lake City, Utah, and 5 years later they were acquired about a year and a half ago by Adobe for $1.8 billion. So real software companies do have real exits also.
Hi, I'm Andrew Lee with, sorry?
I was going to introduce you first, but go ahead.
Yeah.
Andrew Lee from Battery Ventures.
Thanks, Chris. I've been with Battery for about a year now, and I help with our enterprise software and infrastructure practice. Battery's been around for quite a while, since '83, I believe. We're investing out of our Fund 9, which is a $750 million fund. Battery's pretty stage agnostic, so we'll invest very early on in seed stage deals, in writing check sizes kind of for under $1 million. And going as far as doing some middle market buyout investing as well. So very early in seed and early stage, and some growth equity, and even some take private transactions. The firm invests in a lot of different categories, broadly in IT. And so I'm thinking of some of our recent investments in semiconductors. We funded a company called Calzada, which is taking ARM into the data center. On the software side, we've got OpsCode, which is doing some interesting open source configuration management software and systems management software. We're also investors in Groupon, and so that's a characteristic of the way that we invest across multiple categories.
Great, thanks. And then Paul Bricchio from IO Ventures is one of the co-founders. Also a bit of an international flavor in what Paul does as well.
Hey, my name is Paul Briggill. I run IO Ventures. So we're I'd say more of an early stage accelerator than a VC fund per se. So we invest in 5 to 6 companies every 6 months. We usually the first money in, and we kind of really help these companies out by surrounding them with the best individuals. I myself am a 3-time entrepreneur and just recently exited my most recent company. My other 3 partners have started companies like BitTorrent, MySpace, and Hot or Not. Some of our more recent investments. So we did 6 companies. We just had them graduate in October. We do them in kind of class session. 2 of them have gotten acquired. The other 4 all went on to raise a couple $1 million in their follow-on financings. And some of them include SkyR, which is kind of a peer-to-peer marketplace for exchanging experiences. Appstores.com, which is lets people kind of build app stores kind of out of the box. So if your clients like Foursquare or Constant Contact, they're powering their app stores on top of the APIs. So those are kind of 2, relative investing we've done. Besides that, I also have a very international outlook too. I go out there and actually advise a bunch of governments on their kind of ecosystem building and a kind of early stage startup scene. And I've been doing that for about a year as well too, kind of on the side, because I just happen to really love doing that and kind of getting out of this city state sometimes. So thanks.
I'll ask you a little bit more about that later.
Cool.
So in the audience, how many of you have a startup or thinking about a startup? Just so we can see. Okay, good. Okay.
How many are not thinking about a startup?
The smart ones are not thinking about it. So with that in mind then, the funding environment certainly has changed over the last 10 years. And I'd be interested in get comments from the panel on how that change has benefited entrepreneurs in more recent years.
I think it's a great time to be starting a business. I think, I've been away from the venture investment business for about 8 years and came back recently. But to see how capitally efficient you can start a business, I think that's a big deal. There's so many of these big trends that help along with that. I mean, running your business in the cloud, whether it's you compute on Amazon EC2 or using virtualization to save kind of the hardware costs that you have, and maybe not having to ship a system with your product if it's software heavy, putting that in a virtual appliance. There are a lot of factors I think that lend themselves to raising a capitally efficient business. And you talk about kind of having an international scope. I think there's a tremendous regional advantage, I think, to being here in the Bay Area, but the ability to draw from resources, development resources all over the world is there. And to have that communication be available, I think it's a great time to be starting a business. And the capital availability too. I think there are some great funds out there, and an angel community that's very active, and so those things all bode well for the entrepreneur.
Yeah.
So one of the things about being a venture capitalist is that we think of ourselves as risk reduction engineers. And so when we look at a company and say how much money should they take, we would usually say, well, how long does it take to build the product? But how long does it really take to actually touch customers? As Warren Buffett, who's a better investor than anyone in this room, I can guarantee you, says the market bats last. And the big challenge for entrepreneurs, especially in the software sector, is it used to be really expensive to not so much build your product, some took more money than others, but to actually get to market. And that's what's really changed. An angel investment actually makes a difference now. When I started my first software company, venture capitalists didn't like software at all, so you couldn't even go out and look for it. So, I had to just perform unnatural acts as an entrepreneur to get my company going. But now for $150,000 to $200,000, you can not only build your product because the tools are free, you can get on marketplaces, whether it is Android, Apple's App Store, now Amazon's App Store. It might be more expensive to do that. On the cloud, in a social community, and actually touch customers with that $150,000 to $200,000. So that makes the angel round really valuable. But it also means that by the time you get to us, and you're going to ask, you've used up your allowance from angels, and you've spent it wisely. Now you want to get more money, as Paul described, some of his companies get. We're expecting a lot more. You can get farther with the angel round, but the bar is higher for an A round. There are fewer A round investors because people know we're going to have to be with these companies for quite some time. Some of the recent IPOs, a company went public, a SaaS company, Cornerstone, 13 years old, the biggest software IPO last year. ClickTech, 18-year-old company. We don't plan on our companies being 18 years old before they go public. Omniture was 5 from that starting point. But at the same time, we want you to be able to tell us about your customer, not hypothetically, but to have already touched them, either by rubbing sticks together, an angel round, doing it in your spare time. So when efficiency changes at the low end, expectations start rising as more and more dollars you get. But realistically, the ability for an entrepreneur to get in this market, pick any of the 3 bubbles, social, cloud, mobile, the on-ramps to the customer are essentially free. And how your outcome is totally dependent upon the quality of the products you build and your ability to seize a real market opportunity.
Hey, Paul, I have a question, sort of a dovetail on that.
Yep.
When we met last time, you were talking about this current class, and maybe you can talk a little bit about what you do.
Yeah.
But Paul had, I think, over 350 applicants in this class for 5 spots. So how do you look at that, and how do you determine who's appropriate for what you're doing? Because at that point, you've got to get them accelerated to where Ann wants to take a look at.
Yeah, of course. There's a few things we're looking at. First and foremost, we're looking to see if the team is solid, because at such a young stage, the idea is going to change drastically. Every single company I've started, it's kind of always shifted and molded into something else. So we're looking kind of like, hey, is there like one good core technical co-founder? Is there a really good biz dev guy? Is there potentially a designer, or is maybe another technical guy on the design side? Like, we try to find a team that is going to fit well with each other. We're also looking to see if the teams actually work together. They just met each other last week. It's like a relationship. We want to make sure that they know how they work with each other, what's going on, that they kind of have a good kind of working relationship. Once we see that, then we look at the idea, kind of see, is it a general direction good, right? Because if they're going for like a bad direction completely, but they're really about it, we're not going to be the guys who are going to go out there and change their mind. But if they're heading in a similar direction or some kind of vision we think is okay, then we're pretty cool with that. And then finally, we're just looking for, we call it the no asshole rules. I don't want to hang out with these companies, right? If you're bugging me, or you just are really abrasive, or you're not very open to suggestions, then I have no interest in working with you. We're doing this not only to make money, but also me and my partners, we want to hang out with interesting people. So we got to make sure that it fulfills all those requirements, I'd say.
And at I/O, they have Blue Bottle coffee.
Yes. Yeah.
Right. So if you want to hang out, you have really good things to drink there as well. So we have a common thread here in an investment, and I think the stage and the age and the experience of entrepreneurs we're seeing now is pretty young, pretty raw. And I remember when a young kid that we're all familiar with approached me back in 1998. He was 24, right out of college, and not from San Francisco, and looking for money. And 24 at that time was pretty young, I think, to start a company and be taken seriously. But I really liked what I saw in him and the entrepreneur. we ended up writing him a check, and wrote him a check, and wrote him a check, and the company Omniture did go public and was acquired. So we have that common thread.
I don't think he was even 25.